Hi everyone, so this is my step-by-step trade selection process. It's really simple, makes a lot of sense, and it's been proven to work for me for almost 10 years now, and I've been doing pretty well for myself just following this really simple method. And you'll see it just makes a lot of sense. Nothing really surprising here in any way. So step number one is I always check for a good CVOL. So this is the commodity volatility index to find relatively high volatility. And we'll go over a full example of exactly what's going on in the market right now. And you'll see it's very, very simple. Step number two is I want to analyze the graph and just want to see are we in a side trend, uptrend, or downtrend. And after that, I want to analyze the fundamentals of the product that I'm choosing to focus on, or the products. So just seasonality, what's going on with the supply and demand balances. What do we see? Do we have any upcoming events, any upcoming reports that might affect the price movement, and so on. And number four, if everything checks out, I look for a good position, usually short strangles and sometimes short puts. I usually avoid short calls because the commodities mainly crash upwards. So I want to be on the other side of the crash, basically, if the price of the commodity goes up for the most part. But short strangles are also really, really profitable. It's my main approach, but depending on what the market is giving us. So let's look for a good volatility. So if we look at copper, and I only trade 7 products, so it will be pretty simple to be looking at. So copper is at a pretty low volatility currently. If you look at silver, and I always look at the 3 months volatility. Silver is actually pretty high up, so obviously it's not the highest, and I'm not looking for the highest volatility. I'm looking for a pretty good volatility, 65-70% and up from the range that we are looking at. So we are definitely at the upper 70% of the range. So I would consider silver pretty good volatility, something I want to be looking at. Look at gold. Gold is okay. I would consider gold good volatility if it would have been at least over this little spike over here. So right now it's a bit under it, so I would not consider it good volatility as of right now. Look at crude oil. Obviously crude oil is a pretty low volatility. If you look at the monthly one, very, very low currently. Nothing to be looking at. Now if you look at natural gas is also a pretty good volatility. If you consider this range, this is the top and this is all the bottom. This is at the upper 70%. Definitely something I want to take a look at. And the other two products I have is wheat, which is again pretty low volatility. And I always look at the 3 months and then 1 month. So pretty low volatility there. And soybean is the last product that I'm trading. And again, pretty low volatility, as you can tell. So we have silver and natural gas to be looking at. So natural gas, that's right here. Then we have silver, which is right here. So for natural gas, my next question is it an uptrend, downtrend, or side trend? Now this is a bit tricky because it's been going on a downtrend for quite a while, and now it's creating somewhat of a side trend. I'm not sure. So for me right now, it's unspecified, and I wouldn't trade it. If I don't clearly see what's going on, I'm not going to trade it. And let's look at silver. So silver is clearly on an uptrend, very easy to spot it up, right? And again, this is all logical. I'm working just as simply as possible, and it just works. This is the only way that you can really trade, right? So silver is an uptrend, and natural gas is, I'm not sure exactly what's going on as of yet. Now, if you look at fundamentals, so right now, as I'm recording the video, it's the month of September, and natural gas is known to be really, really volatile during the winter time. So September is not really winter, but this is the transition season, which I usually don't trade as well. So for me, it's a no-brainer to not even touch natural gas currently, because I don't know what's going to happen, and because we're heading into the winter season, right? So fundamental wise, I don't want to touch natural gas currently, so this is off the book. Now with silver, if you look at the fundamentals, currently we just had a rate cut of 25 basis points. Now the market, or I guess I'm not sure exactly who, but there is an expectation there might be another rate cut in October. and a rate cut will be bullish for silver like it is for gold. And if we sell puts, in this case, if the price goes up, then it's good for us. Now, if price goes down, volatility is also expected to go down, which will help our position because we're selling a put. So we will have some protection if price goes down. So here I definitely see a reason for the price to stay elevated and not crash downwards, unless obviously something changes. But I would wanna close my position before the next rate decision and follow it closely if I end up opening a position, right? So in this case, I would look for a short put. Now, what will be a good level to be looking at? I would probably look at level 37 because the probability of the price going all the way down here is really, really low. It might go down and kind of like create a new side trend after the all-time high, but really unlikely to drop all the way down to 37 and put me in trouble, right? So if we take a look at the option chain here, see what we can get. So I'll probably go to usually about 90 days to expiration. So this is the March expiration, and I think we are on the December one currently. So let's go to the March one. So March one will also, the 37 strike also looks pretty well. So let's go and look and see what can we get in terms of credit and margin requirements and so on. So let's see here. So we can get $920 in credit, about $16,000 in margin, which is not bad at all. Now, I will probably take one or two positions or per every $100,000. So this is a bit stretching it. I don't want to use more than 30% of my account in margin per position, but I'm here in Canada. The margins are way higher here than they are in different places in the world. So this is, I guess, not an exact matrix to kind of be looking at, but I will probably take two contracts per every $100,000. Could get about $1,840 in credit, and I will take profits at half of this, so about $900 or about $920, and exit the position. And as you can see, we will have a pretty big range and a lot of possibility for things to go the right way for us, right? So if price goes up, it's good for us. We make money because the delta is getting smaller, and theta decay is always on our side. Even if volatility goes up, as long as price keeps going up, it will negate the vega. Now, if price goes down, then obviously we might be losing on the delta because the delta will be getting bigger, but volatility is expected to fall as well, which will help us quite a bit. And again, we have theta decay, right? So I don't know if the price will go up right away or down, but I do know that the probability of price crashing all the way down is very small, and we're taking a small position. 1 to 2 contracts per every $100,000. I'll probably take 2 contracts just to be able to make 0.9% on the account on this position, which is not too bad. And you can probably make it also pretty quickly. How many days? It will be 900 divided by 45. It should take about 18 days, give or take 18-20 days. So not too bad at all. Now, for the position management in this case, I will just probably roll the position at 100% loss, down and out even more. So I'll go out in time to another expiration, and I will roll the position even more, collect the same amount of credit as the position is worth. Now, this is an entirely different video, but it also depends on what happens, right? So if nothing changes in terms of my fundamental analysis at the beginning, which I'm expecting another rate cut, or I expect price not to completely crash down the same speed it went up, we should be completely fine. And even if it does, again, we need to follow fundamentals and make the decision based on that. We might buy a put spread that can make us a lot of money if the price goes down, and again negate the losses, and we can roll the position. But this is again a topic for another video, but this is as simple as it gets for my trade selection process. So just to recap, I just want to find a good volatility relatively for the previous 3 months, This is the number one thing. Good volatility is always a key when you sell options. I want to analyze the graph. I just want to see, is it uptrending, side trending, downtrending? If I'm not sure, then I don't even touch it. I want to analyze the fundamentals, which is the most important step. You need to understand what's going on with the product. And from there, it's pretty easy, self-explanatory to find a good position, pretty safe position. Some people might feel more comfortable selling the 39 put or 38 put and collect way more credit, make way more money. It doesn't really matter at the end of the day, as long as the fundamentals are correct and the volatility is pretty good. So two things, volatility and fundamentals. These are the two things you really care about. The rest can always be improved, and even if it's not the best possible whatever strike selection or position size or whatever it might be, this can be you can still be doing quite fine if you got the fundamentals, if you understand the fundamentals, and you got a pretty good volatility, relative volatility. So that's it for this video. Hopefully it was useful. I tried to make it as simple as possible. This is literally what I do every single day at the end of every day, and then I just kind of mark good volatility. As you can see here, it's marked in green, natural gas and silver. And then I see what's going to happen, how it's going to happen. And the reason I'm not opening this position is because I do have a better position open right now, so I'm not opening this one currently because it's not going to yield enough profit for me to take the additional risk, currently at least. So thank you again, and if you have any questions, let me know in the comments, but it should be it, and I will catch you in the next one.